Most people think qualifying for a mortgage is all about paperwork and bank statements, but that's not the full picture. The truth is, it's all about knowing the rules so you can play the game and win. Today, I'm walking you through how mortgage qualifying really works here in Canada, but more importantly, how to play it smart so you can qualify for more, make fewer mistakes, and move with power. This is the playbook I wish more people followed before they get crushed by limits they didn't even know existed. You'd be shocked to know how many people come to me thinking that they can't even qualify just because the big bank said no. One of my recent clients was recently told by her big bank that she could only qualify for a $360,000 mortgage. She almost gave up when they told her that. I took a deeper look. We cleaned up a few credit items, readjusted the down payment, and utilized rental income from a prospective suite, and boom, she was pre-approved for a purchase price over $550,000. If you understand the GDS TDS game, credit scoring and requirements, and overall insurer and lender policies here in Canada, the doors open up. We can get really strategic with certain aspects of your file. So let's break it down step by step. Step one, we need to know your ratios. There's two different ones, but we're gonna start with the GDS, gross debt servicing. This is the percentage of your income that the lender allows you to spend just on your home. Things like your mortgage payment, your property taxes, your heat, your strata fee. This can't exceed more than 39% of your gross income. Now let's look at your TDS, your total debt servicing ratio. This is the same idea, but this one includes all of your other debt. So your car loans, credit cards, student loans, anything else that reports on your credit bureau. And this, combined with your GDS, cannot exceed more than 44% of your gross monthly income. Here's a quick tip. If you're under 20% down, these are hard limits. You can't exceed that 39%, 44%. But if you have more than 20% down, I have an array of lenders that will allow you to go above and beyond that 39% and 44% GDS TDS. Now, let me give you a really basic calculation. Let's say you make $100,000 a year. 39% of that is $39,000 a year, or $3,250 per month. You could allocate that amount of money specifically to a mortgage payment, property taxes, heat, and if it's applicable, strata fee. Here's step two. Understand the stress test, because this part trips people up. The reality is that even though you're getting like a 3.9% rate, the lender's advertising 3.9, 3.5, whatever it is, even though you're getting that 3.9% rate, you're going to have to qualify 2% above that. So in that case, you're gonna be qualifying at 5.9%. You might be asking yourself why. If I'm getting a 3.9% rate, why do I have to qualify at 5.9%? And the simple answer to that is the government. The government wants to make sure that you will be able to afford your mortgage still if rates happen to be rising in the next 5 years or when you renew next. It's not about today's rate, it's about protecting you from future volatility. So if you're planning to buy a $500,000 property and it's looking like you can qualify based on a 5% interest rate, well, you need to know that you're actually being tested based on a 7% rate. That inherently reduces what you'll be qualifying for, and it isn't reflective of what you'll actually be paying on a month-to-month basis with your mortgage. Step three, your credit score. Think of your credit score kind of as leverage. It's your reputation. It's the trust you've built, proving to the lender why you're worthy of being lent hundreds of thousands of dollars. If your credit score is over 680, you're in good shape. Over 700, well, now you're gold. And if it's over 720, that is the most ideal place you want to be. If you're looking to put less than 20% down, shoot for that 680 mark. Once you're past that, you're in the green. But strong credit doesn't just help you qualify. It allows us to request exemptions on maybe things like ratios, under 20%, things like possible income discrepancies, credit discrepancies. It just overall strengthens your file and allows us to do things that might be a little outside of the box. Lenders are always more likely to approve these exemptions on clients with strong, long-standing credit that shows responsibility over time. And if your score isn't perfect, that's okay. We can often position your application strategically and sometimes even clean up a few items really quickly. Step four, down payment strategy. This isn't just about saving money. This is about unlocking flexibility. Less than 20% down means CMHC insured. That means tighter policies and tighter guidelines. You're not going to see any exceptions made on your qualifying ratios, and they're also pretty strict on income qualification as well. With more than 20% down, you access a world of exemptions, more lenient ratios, sometimes longer amortizations, just overall stronger buying power. And here's a bonus. If you're an investor, putting more than 20% down gives you the ability to write off mortgage interest and allows you to approach real estate like a business. Step five, rental income. And this is the secret weapon. I can't stress this enough. If the property you're buying has a suite or the potential to become a dedicated rental, this can add significant qualifying income to your file, which will overall just strengthen your borrowing power. But here's the trick. Not every lender counts rental income in the same way. Some lenders will only factor 50% of the rental income. Other lenders will use 100%. Some will include expenses. Others will completely exclude expenses. This difference can be worth hundreds of thousands of dollars in your borrowing power. Here's an example. A client's looking at a property with a suite that's going to garner $1,600 a month in rental income. There are lenders that would look at that and say, hey, you're only going to increase your qualifying power by 30 grand. You look at other lenders, that's going to increase your qualifying by $100,000. Same person, same property, different rules. Step 6. Know that the guidelines change based on which lender you're utilizing. This is why it's important to have a pro in your corner. Every bank, every monoline lender, every credit union, every alternative lender has their own lens that they will look through when reviewing your file. One lender might cap heating expenses at $100 a month. Another lender might utilize a specific formula to calculate what the heating is based on the square footage. One lender might love self-employed income, another might have a really hard time qualifying with it. And trust me, you don't need to memorize this. You just need someone that knows how to navigate these policies. I'm that person. Step 7, pre-approval tools. Look, I made this super simple. If you're serious about getting pre-approved and looking at your numbers, just download my app. Inside it, there's an awesome pre-qualification calculator, which will give you a rough idea on what your max mortgage amount is. Use it as a guide, and then book a call so we can customize your real strategy. This is my pre-qualification tool. As you can see, you just gotta enter your data. Enter it as accurately as possible, your income, down payment, purchase price, overall expected debts, and once you get to the end, it'll spit out a number that you can confidently come to me with, and then we can build your strategy off of. Conclusion. The mortgage world isn't just a yes or no system, it's a strategy game. You have to know your numbers, you have to know your strengths, and you have to know the leverage that you already have, but probably aren't even using. The market is competitive, it's fast, but it's beatable if you understand how to move. Whether you're a first-time homebuyer or a real estate investor building a substantial portfolio, the only mistake you can make is doing this alone. You want someone in your corner that you align with, that truly looks out for your best interest, and that knows the rules of the game. That's me. So if this helped, hit that like button, subscribe, and drop a question down in the comments. Oh, and if you're ready to stop being a statistic and start being a strategist, download my app, run your numbers, and let's build your path together.